Welcome to the 50th edition of RealCast, the weekly roundup of the real asset markets. My name's Richard Betts, and I'm joined by James Wallace, Dan Innes, and Nicole Dines. I don't think anyone expected the pandemic to last quite as long or have as much influence when we launched the first edition on the 3rd of April 2020 with Judy Siebers, James, and Nicole to help keep everyone connected with the key trends and headlines. Great to see you back for the 50th episode, James. What have you been following this week?
Well, AXA IM Alt, the French investment manager, has just raised around 800 million to target new development of offices and residential across the UK, France, and Germany. So AXA here is clearly betting on the rebound of office work post-pandemic and that the long-standing urbanization trend will continue. Its announcement reads a bit like a greatest hits of a lot of the popular investor requirements for real estate. They talk about ESG requirements and the need for sustainable business design. They talk about a need to have state-of-the-art technology incorporated at the very outset of new buildings. They talk about the trend towards change of office use and sort of indicating that there's going to be more of a change of use of office space rather than a reduction of office space. And then there's a nod to real estate as a service. They talk about customer service-led approach. So that really incorporates a lot of the best practices from the co-working sector and of course, health and well-being. So workplace access to physical and mental health services may actually become the norm in the years ahead. And that could be seen as a kind of a vital support to employee hiring, retention, productivity, and happiness, and that real estate has a role to play in that. While all these issues are important, though, what I've sort of picked more generally up over the recent months is that it's the attention to ESG objectives, which appears to be the most prominent among investors, and that's both equity and debt, which I imagine will continue to be the center of future real estate capital raising, as well as investment strategies. So my second story concerns British Land. The UK's second largest REIT has rented out almost a third of its One Broadgate City of London redevelopment scheme to JLL, of all tenants, one of the world's largest real estate brokers. So, of course, JLL is at the vanguard of identifying and advising its clients worldwide on emerging real estate trends and its implication. So for JLL to snap up 134,000 square foot of prime real estate in London in the heart of the financial district on a 15-year lease, which they're not going to move into until 2025, is a timely post-pandemic, post-Brexit fillip all round. And of course, if JLL is ready to commit to the City of London office markets for the long term, other companies mulling the same decisions will certainly take note. It's worth pointing out as well that JLL's motivation behind its 15-year lease, it said it's the mutual alignment between itself and British Land on achieving net zero carbon emission. And British Land describes this building as the most energy efficient that it's ever delivered. And it will also be a smart building. So that's a nod to another megatrend. My third and final story, which is connected to the similar theme, relates to Bloomberg's reporting on Canary Wharf Group that it's considering scrapping plans for a new office skyscraper and building a 60-story residential block instead. So Canary Wharf Group is reportedly in consultation now with local authorities to develop around 700 purpose-built homes at its One Park Place scheme. The planning permission is actually public, and you can see it for yourself on the Tower Hamlets Council's website. It would notably reverse an existing planning permission approval that it won back in 2015, and that was to build 1 million square foot of office space. And to put that into context, that was equal to about 2 gherkin-sized skyscrapers that they now want to convert to residential instead. But the reasons behind this are not yet stated by Canary Wharf. But we can join a few obvious dots here. We do know that the Canary Wharf district has been particularly severely affected by the pandemic in terms of its rental income and investment performance. Asking rents for office space is expected to fall by up to 15% in 2021. That's according to Carter Jonas. And that would reflect the steepest expected falls across London this year. By contrast, residential demand and performance has been resilient. But while residential supply and demand dynamics do favor the residential sector, it does remain to be seen what future localized demand to live in a financial district like Canary Wharf will look like post-pandemic.
That debate between office and residential is going to be a big theme, I think. And residential was hitting the headlines elsewhere, Nicole.
Yes, there was significant developments on some key themes that we've been following on RealCast, including senior housing. Gilead Homes, London's leading property developers, announced it's moving into the sector. It is going to build several retirement villages in the south of England, and it's betting on the sector because it says it's significantly undersupplied, and it says that only 1% of the UK's population is living in retirement villages compared to 17% in America and 13% in Australia. So they believe that's a clear direction of travel, and that's where the UK market is going. Another interesting thing that came out this week is the ULI PwC Real Estate Global Outlook for 2021, which underlines twin challenges for real estate. One is the cyclical downturn that's been aggravated, obviously, by the economic consequences of the pandemic. And the other is the rise of ESG, which is a challenge because it obviously there's no clear definition or strategy. So each company has to work out what the best strategy for them is, but it's also an opportunity. And the report underlines the fact that all real estate companies really have moved on from just looking at at occupancy rates and returns and looking at their role in society and their obligations towards society and the environment. So they see that as a great positive. And finally, a really interesting report from Knight Frank, which has some good news for a sector that's been badly hit by the pandemic, which is retail. And it says that the incredible growth in the use of electric cars in the UK creates opportunities for out-of-town shopping centres and retail parks, because the studies show that if there are fast charging points, it encourages people to go to these places and to spend time there. So they suggest that these places invest to lure people back when things open up again.
Yes, the market will be watching the reopening of retail today with a lot of interest, I think. Dan, what have you been following?
First up, the Telegraph is one of the first to report on the activity in the construction sector, which rocketed last month at probably the fastest pace in what they think is about 6.5 years as workloads increase, and any of those stalled projects from last year, they were restarted. So I mean, in results that they published, the March Purchasing Managers Index for construction smashed expectations, jumping up 10 points up to 61.7 from 53.3 in February. And it's the highest reading since September 2014. And that's above forecasts of 54.6. So, every sector in the construction industry, they enjoyed robust growth, and house building being the best performing, going again back to some of Nicole's reports there as well. On that retail topic, today the UK reopened much of its retail. Springboard, they said that they thought there would be a 48% weekly increase in footfall during the first week of non-essential retail this week. But this is going to fall back to an increase of only 10% in the following weeks as consumers kind of direct their spending to the reopening of indoor dining on the 17th of May, which is, of course, the next step. As of today, shops are going to be able to open at the same time as hairdressers and gyms, as well as some overnight stays and self-contained accommodation as well. But there are signs of growth in retail, and there's the rather nice story that came out this week in Belgravia in London. The fashion designer Anya Hindmarch, she's going to open up a 5-store retail concept next month in May, and she's going to call that The Village. Cadogan Estates, which is the family-owned firm that manages much of the property in Belgravia, they've been in discussions with Anya Hindmarch for a while, and Anya Hindmarch thinks that the next 10 years is going to be much more about localization rather than globalization. So watch out for that. That's going to open in Belgravia in May the 17th. And then my last point is really two stories in the ESG market. And Norge Bank, the investment management firm, they've invested 1.4 billion euros to buy half of the Borssele 1 and 2 offshore wind farm in Holland. And that's in line with NBIM's long-held ambition to hold more in this asset class. They, of course, managed that 1.1 trillion euro government pension fund. And unsurprisingly, they didn't need any external debt to finance that deal. But Ørsted, they remain the co-owner and operator of the project. And then lastly, Catella and its European Residential Fund, they've acquired the Lease Tower in Saint-Étienne, which is just near Lyon in France. And it's the first in a planned €2 billion investment program of 100 such residential towers across Europe. And that's aimed at providing more affordable and sustainable homes. The acquisition price of this first tower was about €15 million. It becomes the first one to join that Catella fund, which is valued at €4.8 billion. The managing director at Catella, he thinks it's going to be the blueprint for future and affordable, sustainable residential living in Europe. And that kind of ties back to what James is saying about the switch to residential in Canary Wharf. So, that's certainly one to watch, Richard.
One of the interesting things about doing 50 episodes over the last year has actually been seeing some of these trends coming through. The ESG one for certain, and I was interested to see Olivier Elamine picking up a story in The Guardian which was around net zero, and actually that the way to reduce carbon is to stop building new buildings and focus on refurbishing the existing ones. Also, story around Fore, the European data center operator, which has a presence in France, Italy, Spain and Luxembourg, which is investing 620 million in new facilities to make the most of the ongoing boom in demand. And that confirms another trend that we've been discussing over the year. But interestingly, sustainability is the other key goal. It's important for centres to use renewable energy. So we want to contribute to the transition to a green economy. And since 2017, we've made sure that 100% of the energy we use in our data centers is produced by renewable energy sources. And I think that picks up on a number of the themes that we've seen, particularly over this year. Great to see you back again, James. Thanks very much for joining us. Thank you, Nicole. Thank you, Dan. Thank you for joining us, and look forward to seeing you next week for the 51st edition of RealCast, where we look again at the key themes in real assets. Thanks very much.